Welcome to the Multifamily Investor Nation podcast. With us today is Joseph Gozlan. Joseph, welcome to the podcast.
Thanks, Dan. Glad to be here.
Well, Joseph, I want you to get us started and kind of give us a little bit of a background about you and yourself and where you are in this multifamily space.
Yeah, thank you. I was born and raised in Israel. Moved to the United States in 2007. Did a little bit of single families, got licensed as an agent in Texas back in 08, 09. And then somewhere around 2015, kind of realized that single is not scalable. And after doing a thorough research, I landed up on multifamily. And that's where we started our journey on multifamily. Our first acquisition was in 2016. That was a small 22 unit that we bought ourselves. And then you run out of capital. So we went into alternative capital options like raising money through a syndication. So we started syndicating as well. And long story short, up until now, we have bought a little over 500 units.
That's awesome. That's awesome. And this particular one we're going to be talking about is located in Lubbock, Texas. It's a 236 unit multifamily asset. We're going to be calling this one Metropolitan Apartments. Is that correct?
Yeah, well, that's what it used to be called. We rebranded as the Links.
The Links. Lynx.
Yes.
Okay, great. And so we're at 236. Going to be calling this one the Links. And I want you to kind of tell me how did you find this deal? Was it through a broker? Was it off market? How would you find it?
Yeah, so at that point we already had a little bit over 250 units in town. So people got to know us, owners knew us, brokers knew us. And that was actually one of the brokers we've worked with in the past, kind of reached out and say, hey, I'm working with these owners. This is completely off market. Do you have any interest? So it was basically a relationship with the broker that brought us the deal.
So with this broker, how long had you been having a relationship with them?
It's for just about a year and a half at that point.
Okay. And had you done a deal with them at all at that point?
Yeah, we've done a previous deal with that broker.
Okay. And how far back was that first deal that you had done with that broker?
It was one of our first ones, so about a year and a half.
Okay. So about a year and a half prior to that, it was when you had first made contact with them and closed that deal. And then this was another one that kind of sent your way. Why do you think they sent you this off-market deal?
Because I kept in contact, because I kept talking to that broker all the time. I've built a personal relationship, and that's really what kept us fresh in his mind when he came across the opportunity.
Yeah. And is this just one broker in that market that you've been kind of cultivating the relationship, or have there been multiple brokers?
We work with multiple brokers.
Okay.
We are also brokers ourselves, commercial real estate brokers with a focus on multifamily. So we have relationship with brokers that extend from peer all the way through principal, right? And when we work with those brokers, we tell them, look, we're just buyers. We don't expect any commissions or anything else. So they're a lot more open to working with us.
And does that also help you with your relationship side of things because you have kind of like a almost like a co-equal stance with them?
Yes, and but it really goes beyond the professional relationship, right? You got to take it a step forward and really build a connection. You got to build a true personal relationship with the brokers. That's what really keeps you first in mind.
Yeah. So how were you sent this deal from the broker? Just want to kind of break it down a little bit. Was it a phone call that they gave to you? Was it an email? How did they actually first initially send it to you?
It was one of our usual phone calls, right? I keep constant contact with our broker friends, and it was kind of like, hey, I'm talking to this owner. I don't have anything yet, and we usually tell our brokers, I don't need anything fancy. Just get me a rent roll and a T12 and we can take it from there. And it took us about 2 months to get that seller to the table and talking numbers before we actually got there.
And at what point did you actually tour this property?
We shopped it about a week or two after we were told that's an option. We are in town a lot because we have a lot of properties out there and we have a big team. So shopping that property is as simple as part of our market survey that we do every once in a while.
So were you already familiar with this particular asset when they had mentioned it to you?
Yeah, well, Lubbock is not a big town. It's about 300,000 people. So we know most of the properties in town.
Okay, okay. So when they said, all right, the Metropolitan Apartments is coming up, you were like, I know where that one is. I've seen that one, and kind of already were familiar with it a little bit.
Yes, and it was a very desirable location in town. So we were definitely excited about that.
Yeah, that's pretty exciting. Well, so when you were doing the tour of it, and you kind of shopped it a little bit, were there some concerns or things that came up that might have made you kind of go, I need to make sure we look at this a little bit further?
Well, for us, the only thing that will make us walk away from property is location. Everything else is just a dollar sign. So yes, we saw a lot of deferred maintenance, and yes, we saw some challenges with the on-site staff, and so we knew we were going to have to come in and do a lot of work. And almost all of our projects are heavy lifting, value add. So that didn't scare us; it just spelled opportunity.
Yeah, yeah, that makes sense. And so when you were going through, like maybe submitting your LOIs, your offers on this particular project, were you competing with anybody else, or was it just you?
As far as I know, it was only us.
Okay, so you didn't really know for sure if they kind of sent it out to a couple other people, but you were the ones that they obviously awarded the deal to. Or was there anything that you did to kind of make your group stand out from maybe another group if there was one involved?
Well, we got on the phone with the sellers, right, and did a principal to principal conversation. I think that is a very important step when you are the smaller part of the transaction,
Mhm.
right? And this group owned a lot more properties. So they were doing that for decades, right? I think one of the principals was like third generation apartment owner. And yeah, I know, right? Um, so that was definitely a very interesting conversation. And I think what we needed to show is that we're serious, that we have the experience, that we have the capital, and that we can perform on a transaction like this.
And how many offers and how many kind of like rounds of offers did you even go through, even though might have just been you? Was there kind of several different back and forths, or how did that process work?
We were pretty close up straight up from the beginning. We went back and forth a couple of times, but nothing too interesting. So we were good to go pretty fast. It's just that it took us, like I said earlier, a couple of months to get the seller to recognize that we're serious, to get them to the place where they go through all their people that would needed to approve the transaction and actually get to the point where we can put numbers on the table.
So, I mean, obviously, Lubbock, Texas isn't a primary market or anything, but were you having to put up any like hard money day one, like the earnest money that goes hard day one or anything like that on this particular asset?
No, we haven't done that. I'm also not a big believer in hard money day one. I know some property owners that ask for that, or certain markets command that, but personally, I find it challenging because I've seen a lot of sponsors put hard money day one, and when that sponsor puts $300,000-$400,000 hard day one, what is the real chance that he's going to walk away from that transaction? So that kind of puts people in a corner where I don't want to be in that corner.
Sure, sure. That makes sense. There's definitely some considerations there about, somebody putting up hard money and then, they basically just try to force the deal through because they don't want to lose that hard money.
Exactly.
Yeah, no, that's a good point to bring up. So this particular one, obviously the earnest money didn't go hard day one, but how much time did you leave there for due diligence before it went hard, and how much did you end up putting down for that earnest money?
We had 60 days on the clock from effective date to closing on the contract, and we performed to the date. So the whole transaction, soup to nuts, took 60 days. We had 30 days for inspections and a few more days, I think, for the financial feasibility. That's just normal, nothing too interesting.
Yeah. So did anything come up during that due diligence process?
Yeah, for sure. So one of the things that we kind of discovered in the diligence that you can't see in the tour is that almost all of the roofs were shot, like completely done, needed replacement. So that's something that we had to go back to the seller and say, hey, look, that's a $400,000 expense right there. and they worked with us.
Okay. So what was your original offer on this asset?
I don't remember the exact numbers, but it was somewhere in the 12, $13 million range.
Mm-hmm. Okay. So I know that the final purchase price was like 12.7. Is that correct?
Something like that, yeah.
Okay.
Without the rehab money.
Right. Yeah. Again, then the rehab budget I have here is showing a little over $1 million, like 1.068 or something like that.
Yeah. That's numbers that were almost final, but not the final numbers. We had to move a few things around just at closing, but they're very close.
Yeah. Okay. Yeah. I'm looking at just the executive summary that you had originally put out. So sometimes those things are subject to change based on lending and different requirements and different quotes that come back in and stuff like that.
Exactly.
Yeah. All right. So a couple things about this particular process. You had due diligence. You had the roofs come back. You need to have those replaced. So were you able to go back to the seller and kind of reduce the purchase price, or did they give you a credit at closing?
We got a credit at closing.
Okay. Now, why did you decide to do a credit at closing versus just reducing the offer price?
Let me think about that for a second. I think we did reduce the price. We did reduce the price, and then we got the lender to roll those costs into the rehab money.
Oh, okay. Well, that's nice. So what kind of, speaking of the lending, what kind of financing did you get on this particular asset?
So we did a bridge loan on that one. And with the plans of in about 2 years after the purchase price to go and get a HUD loan.
Okay. And what's the on this particular bridge loan? What did you actually have to buy a cap on it because it was a floating rate?
Yes, we had to. It was LIBOR plus, I think, 321, 325.
Okay.
And we had to buy a cap with another 325.
Okay. And how many years of IO did you get?
It's all IO. It's a bridge loan.
Okay. So the whole thing was IO. So did you have any options to extend it?
Yes, I think we have options to extend to 4 and 5.
Okay. And on the extended years 4 and 5, the interest only extends to that as well, or does principal come due at that time too?
If I remember correctly, it's still IO.
Okay. All right. So you had like a 3-1-1 or something like that?
Something like that, yeah.
3 years IO, and then but the plan on this one, like you said, is to after 24 months try to get into a HUD loan.
Yes.
So what's the hold period on this one?
7 to 10 years.
7 to 10 years, and so what's the benefit of putting it into a longer term or a longer amortization 35-year HUD loan versus just trying to put it into some sort of a permanent 10-year Fannie or Freddie?
Yeah, so HUD loans have pros and cons, right? Everybody knows about the cons where you're going to have to do a lot of compliance and reports and annual inspections and so on. But the pros are undeniable. Like you said, 35 years amortization is phenomenal for the cash flow. It's an assumable loan. It's 35 years fully amortized, which is something that you don't get from Fannie or Freddie because they'll give you a 7, 10-year, 12-year term on a 30-year amortization. So here with the HUD loan, we beat the amortization and the fact that the term is going to be fully amortized, which means the next guy after us can just assume the loan and get a phenomenal loan right out of the gate. The challenge that the reason most people don't do a HUD loan is they take anywhere between 6 and 10 months to close. And in today's market, sellers are not willing to wait 6 to 10 months until you get your HUD loan lined up. So being able to come out of a bridge gives us that length of time to get everything and all the ducks in a row and work with the HUD lenders to get it to closure.
So when you're working with the HUD lenders, are the requirements still the same as far as having to be a stabilized asset when you're like the same thing like when you're working with Fannie and Freddie?
Yeah, they're very similar.
Okay. And are there any 5 years into the HUD loan, if you're starting to drop below that occupancy, do they basically call the note due, or how does that process work?
I don't have exactly 100% sure knowledge of what the HUD loan documents will be in 2 years. But for the most part, neither HUD or Fannie or Freddie is in the business of taking over multifamily properties. They're in the business of lending. So they'll work with you. They'll put you on a watch list. They'll do whatever they need to do to push you forward. But getting something like this foreclosed means you did not communicate or work with your lender.
Yeah, that makes sense. So a couple other things about the HUD loan. You mentioned that it was assumable, which, that's always obviously a nice thing. One of the biggest concerns that I see from, different groups about an assumable loan is that, they have lower leverage, so they have to either raise more equity in order to assume the loan, or they have to do basically a supplemental loan on top of that one in order to be able to assume it. Because obviously, once you get down to that, 10-year mark or whatever, that 7-year mark, there's going to be, a lot lower leverage on that.
Well, this is where you're still thinking Fannie Freddie and not HUD. So when you're fully amortized over 35 years, even 5-7 years into it, it's not going to be that significant drop in your principal. So that's one thing. The other thing is, yes, you can get a supplemental loan and bring it up to the leverage that you're looking for when you buy.
What kind of leverage do they typically have on it?
On a cash out refi, they allow you to go even up to 80% LTV.
Okay. So you're saying even after 10 years of paying on that mortgage, you're still not going to be that far down below the leverage point?
That's just how amortization schedules work, right? In the first 5-7 years, you pay mostly interest and you don't take a lot of bite out of your principal. And that's true to every mortgage, not just HUD mortgages, right? Even your personal home mortgage is the same thing.
Sure. But isn't that the same thing on a Fannie or Freddie? It's all still front loaded in those 5, 7, 10 years?
Exactly.
Yeah. So what's the difference in the front loading of a HUD versus this one? But, obviously you have the difference between a 30-year amortization and a 35-year, but the front loading is still the same.
True, but you're not facing the clock 3 years after the 7, right? So if you take a 10-year loan right now and you hold it for 5 or 7 years, the next guy after you cannot take a supplemental loan from Fannie. Because Fannie won't give you a supplemental loan if it's below 4 years remaining term. In a 35-year HUD loan, 5 years into it, you barely got into the loan.
That's interesting. Now, are you planning on, obviously this is a 7 to 10-year hold, so once you get into it, you're going to have another probably 5 to 7 years left on the HUD, depending on when you guys determine. 30. Say again?
30.
Well, not if you're exiting in 7 to 10 years or 7 to 10 years.
It's a 35-year loan. If I exit after 5, there's still 30 left on the term, fully amortized.
No, I'm talking about your group in the deal, not the loan amount. I'm saying you yourself and your group is going to stay in that property for 7 to 10 years. That's what you said, right?
Yes.
So I'm saying that if you get this new HUD loan 2 years into it, you're still going to have 5 to 7 years left of your group in that HUD loan.
Yes, correct.
Right. So if you're in that deal for 5 to 7 years, you're obviously increasing your cash on cash by doing that HUD loan because you're able to amortize it out over those 35 years instead of doing the 30 year.
Precisely.
Yeah. And what kind of, obviously, it's hard to project, 2 years out, but where are you guys seeing that number one, that some of the projections might be from a leverage point at that point, and then for the person who's going to assume it, and then any ideas, obviously, you probably don't have any idea on the interest rate, but you're hoping you'll get the best rate. But I would hate for obviously you to lock in a higher rate, and then in 5 to 7 years when you're trying to exit that deal, the rates are actually lower, and so nobody wants to assume it, because that's the risk you take as well with that, right?
That is correct, yes. But that's true to Fannie, Freddie, any long-term hold that you have. We can't predict. We don't have a crystal ball, right? So I can't tell you what's going to happen to the interest rates. If you would ask me a year ago, I would tell you we'd be much higher than we are today with the interest rates. But the fact is that today the rate is actually lower than the same time last year by almost more than a quarter of a point. So we don't have a way to predict what's going to happen in 7 to 10 years. We did assume that 2 years into it, when we're going to take the refi, the rates are going to be higher. If the rates continue to stay they are today, it's going to be even better for us. We're also taking assumptions that cap rates are going to expand when we're going to do an exit. So these are all buffers that we put into our underwriting to kind of protect our investors.
Mm-hmm. Yeah, no, those are definitely great buffers. So speaking of like a entry or an expansion of the cap rate upon exit, where do you typically put your cap rate whenever you're in a deal like this? Because obviously you're 7 to 10 years, so that's kind of a big range. So how do you project an exit cap on that? So I guess the biggest question is where did you enter this deal, and where did you project the exit to be?
Yeah, so what we like to do is in most of our transaction, and really it depends from project to project, and are we buying a B class in Dallas, or are we buying a C class in Lubbock, right? But for the most part, when we deal with the C class and the secondary, tertiary markets, what we like to do is to take the stabilized cap rate in that market right now, and then add a full point to it. So if the stabilized cap rate is 5, we'll do 6. If it's 6, we'll do 7, and so on.
No, that's good. And that doesn't matter how long you're in the deal. If you're into it for 3 years or 10 years, you always add an extra point to it.
Yes. And that extra point at a transaction this size is over $1 million in proceeds that we take off the table in the underwriting. Mm-hmm. And if we don't have to, in reality, that will be cherry on top.
Mm-hmm. Now, on this particular asset, you started with the bridge, and obviously, bridge loans are riskier type loans when you're getting started with a deal. I'm looking at the executive summary, and it was showing that the occupancy is above 90%. So obviously, it was a stabilized asset. What was the main reasons behind doing the bridge loan on this asset?
Well, actually, that wasn't a stabilized transaction. It was 92 physical. But the economical was not there. Okay. We had a bunch of people that didn't pay. We had a bunch of people that couldn't do that. And then the massive rehab that we needed to do, over $1 million in rehab, that what drove us to a bridge loan, because we knew it's going to be a lot harder to get through Fannie and Freddie with that much deferred maintenance. So that's why bridge was the best option at this point.
Mm-hmm. And what are the biggest risks that you see with this type of an investment? You're starting with a bridge that you always want to make sure you're cognizant of moving into it.
Yeah. So the challenge with properties this size is that they are big tankers. They don't turn on a dime. So it's a slow, painful process to get them to turn and start improving. So when we did over $350,000 worth of work on the roofs, nobody see a difference, right? There's no noticeable difference in the appearance. There's no noticeable difference in the interiors. There's nothing that can convince new residents that the property has changed. But it's work that still had to happen. So that's really where this is. It's the risk comes in from the size of the property and how long it takes to turn it around.
And how much of the CapEx was kind of geared towards, interior renovations?
We have about $400,000 in the budget just for interiors. The majority of the work that we had to do is exterior. We had to do roofs and we got to repaint it, and sidings and landings and staircases, and a lot of rotted wood on the property that we had to replace. We want to do the asphalt. We want to do exterior lights. We're doing a small park. There's a lot of projects, covered parking. There's a lot of projects that are on the exterior and not necessarily on the interior side.
Mm-hmm. Yeah, that's definitely a little bit of a challenge. So where were you projecting the increase in the value add? Because a lot of times, like you said, you replace roofs, you can't go, oh, I just spent, almost $400,000 replacing roofs, and I can do a rent bump of $50 or anything. You wish you could do that, but it doesn't happen that way.
I wish it did work that way, but it doesn't. No, but with the exterior projects, it will help with occupancy. It will help with retention. It will help with attractiveness of the property. Nobody wants to come to live in a property that looks like it's about to fall apart. So that's really where that CapEx does help you, just not in a direct dollar for dollar kind of equation.
Yeah. Yeah. So where were your projections as far as being able to increase the rents, on this particular asset after doing some of these renovations?
So yeah, so we noticed that the difference was quite big. We had over $100 difference per door on those units from what the market is, and that's comparing to the two properties that are right next to us, and that's even comparing to other properties that we have in town in inferior locations. So the difference per door is ranging from 100 to almost $200 per door.
Mm-hmm. All right, cool. And this particular asset, how much was the equity raise from investors?
It was 3.3.
3.3 million. And how many individual investors did you end up getting for this deal?
I think we ended up with just a little over 30, 32, something like that.
Okay, that's about right. Minimum investment was 50,000.
Yep.
Okay. And so when you were talking with investors about this particular project, I know, it was last year, so, it might not be as fresh in your mind, but what were some of the questions that they maybe presented to you before they had decided to invest with it?
Well, the obvious first question is why Lubbock, right? And we had to help them understand the market, the economics of the market, and why we felt the market is a good market to invest in. I can repeat that if you're interested.
Yeah, please do.
Yeah, so we love Lubbock because it's a good market to be in. It's a little over 300,000 people in town, so it's not a big market, but it's not too small and random. The big dog in town is Texas Tech. That's the university. Their Big 12 conference. They have over 37,000 students in town, and while we don't do student housing, the math is very simple. For every 4 or 5 students the university adds, there's a new job in town. Students needs a lot of taking care of. They need bars and restaurants and pizza and dry cleaning and medical services and so on. So the university brings about $1.2 billion every year to the city's economy. Just retail shopping alone, the students do over $300 million a year. The other big dog in town is the medical system, which started as the playground for the university for them to test the programs and enhance it. But they ended up putting so much money and research and technology into the hospital that it became the most important hospital in over 100 miles radius. So now it's its own thing, and it brings patients from out of town, which drives the economy into town and so on. So unemployment rate in Lubbock is usually over a full point below the Texas, which is always below the state, the national unemployment rate. I think last I checked, it was like 3.1 in Lubbock, 3.9 nationwide. And Texas was like 3.8 or something like that. So really that's the power of Lubbock, and having the scale already in town of about 250 units allowed us to kind of leverage that scale and grow to the 500 units in town, leveraging our staff, leveraging our presence, leveraging our knowledge of town, and so on.
Is that where you're located, is in Lubbock?
No, I'm actually in Plano, Texas, just north of Dallas.
Okay. So, and correct me if I'm wrong, but I think I have an idea. Where is Lubbock exactly located?
It's northwest from here.
So it's northwest.
300 miles northwest. I'm sorry?
So is it on the Panhandle?
Yes.
Okay. All right. So, yeah, I would definitely say that that's probably, one of the biggest hurdles is to educate the investors on the economy of Lubbock and really understanding those economics, which can really get them to once they understand that, they're wanting to be able to invest in it a little bit more.
Yes.
Especially you having already a presence in that market, help them, understand it some as well.
Absolutely. Yeah, that was the idea.
And this particular investment, you had about a little over 30 investors, 3.3 you said was the raised?
Correct.
How long did it take you to raise that 3.3?
We had about 45 days realistically, but in fact, it was more like a 30-day condensed race.
Yeah. And what were some of the biggest challenges that you had in raising the money? Not necessarily the questions, but some of the logistical things.
Actually, we didn't have any logistical challenges. We got to our network. We did a few webinars. We have a recording. We also have a video on our website that describes the process of investing. So we kind of got our investors ready, knowing what's the next step. We do 506Cs, so accredited investors only. So we got all of them through the process of providing the proof that they are accredited investors. Wasn't that complicated. I know a lot of people are worried about doing 506Cs because it sounds complicated and logistically challenging, but it really wasn't.
Mm-hmm. Yeah, no, that's definitely a consideration. Our group is actually at this point have only done 506Bs. And we've definitely considered doing the 506Cs, but obviously there's some different considerations. So that's a great kind of segue point to start talking a little bit about the 506C. And so what are some of the reasons why you choose to do a 506C versus a 506B that make it a little bit easier for your group?
Well, 506B has a lot of rules attached to it, and most of those rules have not been tested in court. Really, the whole substantial relationship, the whole, do you know the investors? Did you verify? The law, the SEC regulations put the responsibility on the sponsor to make sure that investors is sophisticated enough to understand the deal. And just syndication deals in general are pretty complicated. And if you ever have to go to court and try to prove that you've done whatever you could to show that this investor is sophisticated enough to understand the deal, I feel it's going to be a lot of challenge for a lot of people. And I heard a lot of urban myths like the 3-touch rule, right, and all these things. And I'm a very risk adverse person, so we could make it happen with accredited investors only. So we chose to stick to accredited investors.
Mm-hmm. And yeah, we've actually found that in most of the projects that we've put together, only about 5 to 10% of our investors were non-accredited. Most of them fit that criteria of being accredited. I think one of the biggest downsides, which again, I think of it as a big downside, and you might go, it's not that bad, is having to do that third-party verification on the investors.
So you don't really have to do a third-party verification, right? The SEC regulation requires that you make a step to confirm that this investor is an accredited investor. So that could be anything from getting their tax returns, or getting their W-2s, or just getting an account statement. Let's say if they have a stock portfolio over $1 million, an IRA account over $1 million, either one of those is enough to prove them as an accredited investors. And as long as it's a legit statement that has a recent date on it, right? It has to be within the last 90 days. You can do that. And then there are third-party services for the ones that don't want to expose their financials, right? I think it's called verifyinvestor.com. For $20, $30 fee, they do whatever they need to do with that CPA, and they bring you a document that says they're accredited. And then lastly, they can always go back to their investor or their CPA or their tax attorney and have them print on their letterhead that they know that person's financials, and according to the SEC regulation, they certify that they are an accredited investor. So it doesn't have to be super complicated just to get this verification. And most of the accredited investors already have a CPA or a tax attorney that they already work with.
Mm-hmm. So you really wouldn't say that that's really that big of a challenge to be able to go get over that hurdle?
No, we haven't found that challenging at all.
Did your investors find it challenging?
Not a blip.
Yeah,
we haven't heard.
That's all good information to know, because as our group decides to move forward, I've been asking a lot of people about that, because obviously there's the considerations of of making your investors have to do more things and take more steps, and they might reduce their likelihood of investing.
Well, it's about educating them, right? You got to help them understand what this is for, and you got to give them a heads up that this is part of the process. And once they realize that it's part of the process, then they go through the step. And it's not that big of a deal. Most of our investors just shoot an email to their CPA.
Mm-hmm. And is there like a letter that, or some wording that you like provide them that their CPA has to put on their letterhead, or how does that process work?
A lot of them already knew the format and had their own formats, but the ones that didn't, we just shared a few samples of letters that we've got in the past, obviously, reducted, but the CPAs saw those samples and they came up with their own and sent it back.
Mm-hmm. So this one being a 506C, did you take advantage of the general solicitation and do some sort or some form of marketing generally or advertising to be able to get these investors?
Not like paid advertising of it or everything else, but it does allow us to post on Facebook on our page to say, hey, we have an opportunity coming up, reach out to us and we'll give you the details, which some people will call it general solicitation. Some people will say it's, well, you put it on your own group and only to your people. Maybe it's not. I don't like walking that gray line. So having the 506C gave us the peace and quiet, knowing that a post like this is not considered a risk in the format that we do.
Yeah. Now, when you actually put those posts out there about this particular deal, do you make sure in the post that you say that it's a 506C?
No, we just say, we don't post numbers. We don't post any specific offerings, right? We just say, hey, we got something coming up. Go to our website and sign up for the webinar to learn more. Yeah. So we don't really get into the details in the advertising itself. Mm-hmm.
So, it doesn't sound to me like there's really any downsides other than the fact that you can't bring your sophisticated investors in.
Yes, and it is a downside, right? Because you have people that reach out and you'll have to turn them down because they don't qualify as accredited investors, and it is what it is. And sometimes it's friends and family that you're going to have to turn down, but that's the only downside you have.
Yeah, that is interesting. Yeah, it's one of those considerations that we've definitely spent a lot of time and energy and effort on, and I've been, traveling around and doing different workshops around the different regulations, Regulation A with Tier 1 and Tier 2 funds, and, your $20 and $50 million funds with Reg A, and then your Regulation D, 506B and C. And, I've even put a chart together for that. Those, it sounds to me like it's not really that big of a deal. Just do it,
If your investor pool is mostly accredited, then it's not a big deal. If you keep doing 506Bs, then I highly recommend that you go read the source of all those urban myths, and that's the Citizen VC letter, VC as venture capital. That's a company that was doing syndication. They sent a letter to the SEC saying, this is our process, and they describe a very long, rigorous process. And the SEC came back and said, yes, if you do all of that, it's okay. You've proven that this investor is sophisticated. But I haven't met anyone that does 506Bs that actually go through all that rigorous process. That's my concern. Is it's based a lot on urban myths, and I heard this on a podcast kind of statement. But you really got to understand what you're dealing with, and the SEC is a federal body that you don't really want to mess with.
Mm-hmm. Now, how did you structure the deal with your investors as far as like equity splits and promotes and preferred returns and various things like that?
Yeah, so we don't believe in waterfalls. They're too complicated to explain and too complicated to understand. And we tell our investors, look, if you need a CPA, a tax attorney, and a NASA scientist to figure out how much you should be paid, somebody missed the ball over here, right? So our splits are pretty straightforward. We split from the first dollar. Sometimes it's 70-30, sometimes it's 80-20, sometimes it's somewhere in between. It doesn't matter what the split is. But we split from the first dollar, and our investors have preferred return, which basically serves as a safety net. So if we split it and there's not enough money to cover the preferred return, then money moves over from our bucket to the investor's bucket to make sure that they get the at least the preferred return. We also have all of our preferred return is cumulative. So even if we have a tough year or a tough quarter, and we have to either distribute less or not distribute at all, and these things will happen in the lifetime of a property. That's just the nature of the beast. Then our investors know that we're going to be catching up their preferred return before we see any dollar, ourselves as sponsors, right? So they're always subordinated. Our returns are always subordinated to the limited partners. And the same thing on the back end. When we make a sale, first we have to pay the investors all the remaining capital, and only then we consider the remainder as profit, and we're going to split that with the investors.
So you really are doing a structure where it's not a 70-30 split of the deal. It's a 70-30 split of everything over on top of after you've returned their initial capital, plus you've given them an 8% return.
Yes.
So you're not doing a true up once you sell it to get you equal with the 8% before you do that split.
Not the 8%, but there is a true up because everything is cumulative in our transactions.
Okay. And is that true up usually done at the end after you sell the property?
Yes.
Okay.
Yeah. If we can true up along the way, that will be great. But if not, it will go all the way down to the end.
Okay. All right. That makes sense. Let's see here. What can you think of anything else that might have came up throughout the process that might have been interesting or anything like that?
Yeah. So when we were working on this one, we actually started talking to a private equity group, and they underwrote it and they worked with us, and they were willing to cut a $3 million check for us. And we had to turn them down, which was a very unique experience, really. But because they're not used to people turning checks down. But we were so far along the process, they just took a long time to go through, call it the dating phase, right? Getting to know each other and the underwriting and so on, that we were already halfway through the loan. And if we would have told the lender that we're going to bring a private equity group, that would have caused a lot of delay and a lot of noise in the system that we just couldn't afford taking them in at that point.
Mm-hmm. Now, were they wanting more control or potential control or some extra equity in order to bring the whole check?
They usually bring anywhere between 80 and 90% of the raise, and they do want more control than your average LP. Yes.
Yeah.
But that's true to all of the private equity groups.
Mm-hmm. Yeah, that's very true. Now, were they wanting more equity though because they were bringing a larger check, or was it just the control piece?
It was the control, but they also wanted larger acquisition fees.
Okay, they wanted to have a seat on the GP side.
No, they were strictly LP, but they were charging an acquisition fee as part of the process.
Oh, they were charging the acquisition fee.
And a big one.
Like
a big one.
Capital fee or something.
Yeah, well, you can call it whatever you want to call it, but they wanted a chunk of money.
Yeah, up front. Well, I mean, it was great that you were able to get it without having to use them. So makes it a much more profitable deal for you as a sponsor too.
And for our investors, yes.
Yep, absolutely. Well, that's the thing too, is if after you've already accepted money from investors and then you have to go back to them and change things, now they got to redecide if they want to stay in the deal because the deal has changed since now that you're bringing in the private equity.
Yes.
So it makes it definitely much more complicated.
Yeah, and we wanted to work with our private investors because it's a good opportunity for them to deploy their cash and get good returns and be a relatively low risk investment.
So I have two kind of final questions that I always like to ask everybody. And, the first one is about, what did you find was easier during this entire process that you thought maybe originally might have been a little bit harder?
The loan. One thing I learned is once you cross the $10 million loan line, the lenders become a lot nicer to you.
Yeah, that's very true. I've had that very similar experience. We did a smaller, like $3 million deal that they were a lot more scrutinized than a deal we did that was over 10 million.
Yeah.
It's always amazing how that works,
Yep.
So on the flip side, last question here, what did you find that was harder than you had originally expected?
Um, we got handed over from the bridge loan to a servicer, which is Wells Fargo. Um, and they're not fun to work with. Let's just say that.
Are you using a company by the name of Bancor?
No.
It's just a different lender, but they're using Wells Fargo as the servicer.
Yeah. Wells Fargo is a big corporate beast, and you don't have a servicer that you can communicate with. There's like an anonymous email box, and you send an email over there, and you get an automatic reply that will look at it in 5 to 7 business days, and they get to it only on the last possible business day. And then they tell you, oh, you forgot this, and then you're going to have to wait another 5 to 7 business day. So it's really very uncomfortable to work with them.
And you get that one draw a month. And so if you miss those deadlines, you have to wait to the next month to get your draws.
Exactly. Yeah. So it sounds like you've experienced some of Wells Fargo's fun procedures.
Yes, I have definitely experienced that. So I can definitely understand what you're going through right now. We're doing the same thing, and you just always have to stay on top of it. And you're right, like 5 to 7 business days, and it's the 10th business day that they usually do it probably.
Yeah.
So
anyway, at some point we needed to, just one more story about Wells Fargo. We needed to change the auto draft for the mortgage from one bank account to another. It took me 3 days on the phone being transferred around from one department to another because nobody knew what I want from them. At some point, I even landed talking to a first line tech support person that was convinced that Lockbox is the name of my company. So, it was definitely an experience.
Well, that's pretty crazy too. Well, Joseph, thank you so much for spending some time with us today, going over this property, got the links in Lubbock, Texas, and kind of diving deep into some of the specifics with it. It's been an educational experience for me. I know it has been for our listeners. And how can the listeners reach out to you if they want to get some more information from you or possibly do some investing alongside you in some of your projects?
Yeah, just going out to our website is the easiest way, ebgtx.com, just 5 letters, E as in elephant, B as in boy, G as in George, T as in Tom, X as in X-ray.com.
Couldn't have made it any easier, huh?
Nope.
Well, we'll make sure that inside of the show notes and stuff like that, we'll put those links so people can reach out to you. And again, thank you so much for your time, and look forward to having you on a future episode as you close more deals.
Sounds great. Thank you so much for having me.